In this video, I'm showing you the simplest way to master bankruptcy and insolvency accounting. You will learn exactly how to prepare a statement of affairs and deficiency account without losing a single mark in your exams. Let's get started. So I want to start with deficiency account. Deficiency account tells the story of how the final deficiency arose. It tells the story of how the final deficiency arose. So that means it explains what gives rise to deficiency. So what are the items that give rise to the deficiency? So that is what deficiency in account is all about. It is the reconciliation. The essence of deficiency in account is to reconcile the position of the bankrupt. So these accounts have two sides. There are two sides to deficiency account. We have the left-hand side and the right-hand side. The left-hand side, we have items reducing deficiency. Items reducing deficiency. So those are the items we normally have in the left-hand side. So we have items reducing deficiency. What do we mean by that? The bankrupt, maybe because of the accumulation of losses, that is why the bankrupt was unable to settle his or her debt. So what are those items that will lead to the reduction of the debt of that bankrupt? That is what we are talking about here. The item that will make the debt of the bankrupt to reduce. The items that will make the losses of the bankrupt to reduce. Those are the items we normally have at the debit side. Items reducing the deficiency. When there are profits, losses will reduce. Profit will lead to reduction of the debt of the bankrupt. So we have items such as capital. Number one, we have capital or excess of assets. Excess of assets over liability. Excess of assets over liability. That will reduce deficiency. Now, if you have trading profit, that is profit from trade or business, trading profits, profit from trade or business. If a business make profit, the profit will reduce the debt. The profit will lead to reduction in deficiency of that business. Then gains from disposal of non-current assets. Gains from disposal of non-current assets. Where you have the realizable value, where the realizable value is greater than the carrying amount, is greater than the net book value. You may note that where the realizable value, you'll be given the realizable value of the asset. Then you'll be given the book value of the asset, that is the carrying amount, cost less accumulated depreciation, the value recorded in the financial statements. So where that is given, so you compare it with the realizable value of the assets. So if the realizable value is greater than the book value of the asset, then that means you have gains from disposal of the asset. For instance, if the realizable value of the asset, if it is $10,000, $10,000 realizable value. So where I put RV, it means realizable value. If it is $10,000, the book value, that is the net book value of the asset, if it is $9,000, then the realizable value is greater than the book value by $1,000. That $1,000 is a gain from disposal of non-current assets. So you may have the PPE, such as we have people in motor vehicles, land and buildings, furniture and fittings. Always compare their book value with their realizable value. So where the realizable value is greater than the book value, then that means you have gains from disposal of the asset. That gains will be recognized as part of the items that will reduce the deficiency. Remember, we are looking at the items reducing deficiency. Items that will reduce the debt or the losses of the bankrupt. So I've made mention of capital or excess of assets over liabilities. Then the trading profits, where you have profit, where the business is able to make profit. The profits will lead to reduction in the deficiency of the business. Then if you have gains from disposal of assets, I've told you we have gains where the realizable value is greater than the book value. So RV means realizable value. Take note of that. Then we may have bad debts recovered. Bad debts recovered. Bad debts recovered will lead to reduction in deficiency. You have bad debts recovered. So when you recover a debt that have been declared bad, that is those debts that you think you may not be able to recover before, so you have written them off. So subsequently, in subsequent years, they were now recovered. That means the business is getting more income. So bad debts recovered will lead to reduction in deficiency. Then we may have investment income. Investment income, where the entity has some investments. So the company, the investee company might pay some dividends to the company. So the investment income, so it's an income to the business, so it will lead to reduction in deficiency. So realizable value of personal assets. So where you have personal assets, so their realizable value will be considered here. Not the business asset this time around. Realizable value of personal assets. Of personal assets. Realizable value of personal assets. So it will lead to reduction in deficiency. These are the items that will lead to reduction in deficiency. So at the right hand side, that is the credit side, you have items contributing to deficiency. Items contributing to deficiency. Items contributing to deficiency. That is those items that will worsen the debt of the bankrupt. Items that will worsen the position of the bankrupt. Items that will worsen the losses of the bankrupt. Items that will make the debt of the bankrupt to increase. This excess of assets over liability, you will need to ascertain this where you are not given capital. If you are given opening entry, so you add all the assets in the opening entry, less liabilities in the opening entry. That is how you will get the excess of assets over liabilities, just like incomplete records or single entry. So you make use of the opening entry. You consider the asset, you sum up all the assets in the opening entries, less all liabilities in the opening entry. That is what will give you the equivalent of capital. So you are going to have here, that is where you are not given capital. Or I've told you where capital is not given, that is how to look for that. Then if the liability is not greater than assets, you have them here. So that means we contribute to deficiency. So excess of liabilities over assets. Where liabilities is greater than assets, it will contribute to deficiency. It will worsen the position of the bankrupt. It will worsen the debt of the bankrupt. It will worsen the losses of the bankrupt. So if you have trading losses, loss from trade or business, trading losses, loss from trade or business will worsen the position of the bankrupt. Then if you have bad debts written off will contribute to deficiency. So where the business withdraw something for personal use, drawings Drawings will contribute to deficiency. Then, if you have a research written off, or any expenses written off, will worsen the deficiency of the bankrupt. Then, if you have interest on loans, where you borrow loans and the loans attract interest, so that means the debt you are to pay will increase by the amount of interest on that loans. So it will contribute to deficiency. The interest on bank overdraft, if any, interest on bank overdraft, that will contribute to deficiency. Then if you have liquidation expenses, or administrative expenses paid to the receivers remuneration, administrators remuneration. So you might include them here. Receivers remuneration, administrators remuneration. So they will all contribute to deficiency. Loss from disposal of non-current assets. Loss from disposal of non-current assets. Remember, I've talked about gains from disposal of non-current assets. I've told you where realizable value is greater than the book value, you have gains. But this time around, the book value is greater than realizable value this time around. The book value is greater than the realizable value. The amount by which the book value exceeds the realizable value, that is the loss from the disposal of the assets I'm talking about. Then, after all this, in case you have deficiency reported in the statement of affairs, deficiency as per statement of affairs. So you have it here. But if it is surplus you have there, from there, you have surplus as per statement of affairs. Though the statement of affairs will be prepared before the deficiency account. After all this account will balance itself. The second account is statement of affairs. Statement of affairs. A statement of affairs shows the financial position of the bankrupt on the date the receiving order is passed. Statement of affairs shows the financial position of the bankrupt on the date the receiving order is passed. That means the statement of affairs is equivalent of balance sheet. It's equivalent of the statement of financial position. Always think of this as a final balance sheet of a failing business. Always think of the statement of affairs as the final balance sheet of a failing business. For the purpose of the statement of affairs, we are going to look at the classes of creditors. Classes of creditors. I will use this mnemonic based on the order of arrangement in the statement of affairs, USMP. USMP. The first letter U stands for unsecured creditors. Unsecured creditors. Unsecured creditors are creditors who do not hold a security in interest. Creditors who do not hold a security interest in any asset of the business. They do not hold a security interest in any asset of the business. No collateral. They don't have any collateral. No collateral was used for them. It means as at the time these loans were borrowed, the company did not stand with any of their assets. They did not use any of their assets as a collateral. And you may also say that unsecured creditors are creditors who do not have any asset as security for their debts. See, creditors who do not have any assets, who do not have any assets of the company or of the business as security for their debts. In other words, unsecured creditors are creditors who do not have any specific asset pledged to them. They do not have any specific asset pledged to them. No lien, no pledge, and no security. So no lien, they are not used. They don't have any lien on them. No lien on any asset of the company. They are not pledged. There is no security for them. So that is unsecured creditors. Examples of unsecured creditors include trade payables or trade creditors, trade creditors, bills payables, bank overdraft, unless it is pledged on a specific asset. Then accrued expenses. So when you are given a question, you check if there are security used for any of these. If there are no security for them, if there are no collateral for them, you know that you are going to classify them as unsecured creditors. That is first letter U. After letter U, we have S. The S stands for secured creditors. S for secured creditors. Secured creditors. These are creditors that hold a charge over specific assets of the business. They hold a charge over specific asset of the business. That is, there is collateral. In obtaining those loans, the entity use an asset as collateral. That is why we said they are secured. These secured creditors will be categorized into two. We have fully secured creditors, fully secured creditors, and we have partly secured creditors. The fully secured creditors is the creditors in which the realizable value of the security, value of security is greater than or equals to the value of the loans. The realizable value, you don't compare the book value, you don't use the book value. What you should compare is the realizable value, not the book value. If you check the realizable value, if it is greater than or equal to the value of the loans, you know that the creditors is fully secured. But the partly secured creditors, the realizable value of security is less than the value of the loan. That means the amount of the loan obtained is more than the value of the asset used as security. I've told you, you don't use the book value. What you should always consider is the realizable value of the assets used as security. Now, after letter S, the next letter is letter M. M stands for money owed. Money owed. This will be categorized into two: deferred and distrained. Deferred and distrained. Money owed will be categorized into two. We have the deferred and the distrained. So I'm starting with the distrained by rent. Let me have A, distrained, creditor distrained by rent. Creditors distrained by rent. That is landlord who have seized assets for unpaid rent. So distrained by rent, creditors distrained by rent, we are referring to the landlord that have seized the asset of the person for rent. They have special right to receive arrears from asset proceeds. They have special right to receive their claims from the proceeds of the asset. That is creditor distrained by rent. Then after the creditors distrained by rent, we have deferred creditors. Deferred creditors. Deferred creditors are the last in the line. Example of deferred creditors are loans from a spouse or partner that are contractual subordinated. Loans from a spouse or partner that are contractual subordinated. That is an example of deferred creditors. Then after letter M, the last letter is letter P. P for preferential creditors. Preferential creditors. They are preferential because they receive preferential treatment. That means in the event of liquidations, they will be settled before everyone else. They get paid from the free assets before anyone else. Preferential creditors get paid from the free assets, not those assets used as collateral. The ones that are used as collateral have been secured on particular asset. Those who are not used as collateral, that's what I mean by free assets. They get paid from the free assets before anyone else. They receive preferential treatment. That is why we call them preferential creditors. Examples of preferential creditors are wages or salaries of employees 4 months to the date of the receiving order. Wages or salaries of employees 4 months to the date of the receiving order. Then unpaid government taxes. It's an example. It's another one. Unpaid government taxes 12 months to the date of receiving order. Unpaid government taxes 12 months to the date of receiving orders, such as the value-added tax, the payees, and others. So they fall within that category. That is, they fall within preferential creditors. Format of statement of affairs. Format. Let's have Mr. Debtor. Mr. Debtor. That is the name of the bankrupt. Statement of affairs. Affairs. As at whatever date you have in the question. Then this is for particulars. This is gross liabilities. This is particulars. This is expected to rank. Expected to rank. Liability expected to rank. So we have the book value of the asset, book value. Then we have estimated to realize. Estimated to realize. This is asset side. Assets. So let's have particulars here. This is liability side. Particulars. The currency is US dollar. So remember the mnemonic I gave you? That is USMP. That is the order of arrangement, USMP. The first letter is letter U. U for unsecured creditors. How much is the unsecured creditor? You put it under the gross liability. Then you put the amount under the expected to rank. That is unsecured creditors. After letter U, we have secured creditors. Remember, I've categorized the secured creditors into two. We have fully and partly. So it starts with fully secured creditors. Fully secured creditors. Under fully secured creditors, you may have mortgage loans, mortgage loan. How much is the loan? You put it here, then you put it under this column. Then realizable value of security. Realizable value of security. Not the book value. Remember, for fully secured creditors, I've told you that the realizable value may be greater than or equal to the loans. So as a result of that, you have the surplus in hands of the fully secured creditor. This will be a surplus if the realizable value is greater than the value of the loans. So this is the surplus in the hands of fully secured creditors. After fully secured creditors, we have partly secured creditors. Partly secured creditors. Partly secured creditors. Then you have the value of the loans. Put it under gross liability and this column. Then realizable value of security. Value of security. Remember, I've told you that for a partly secured creditors, the realizable value will be lower than the value of the loans. As a result of that, the amount by which the loan exceeds the realizable value will be ranked in pari passu with unsecured creditors. So we've done with U and S. The next letter is letter M. M is for money owed. Remember, I've categorized that into two. Money owed. I've told you you may have distrained rent, and then you may also have deferred liability. Yes, deferred creditors. So we want to start with distrained rent. Distrained rent. How much is that? Realizable value of security. The realizable value may be greater or it may be lower. If it is lower, the amount by which the creditors, the liability exceed the realizable value of the collateral. So you are going to rank that as unsecured. But if this security, if the value of security is greater than the value of the liability, then you have the surplus. Then you might also have contingent and bankruptcy costs, though I didn't include that in the mnemonic I gave you earlier, but I want to include it here. Contingent and bankruptcy costs. The one not previously provided for. The one not provided for, that were not provided for previously. So you need to rank it here. Then you also rank it in pari passu with unsecured creditor, contingent and bankruptcy costs. Remember, we are still under M. The M, we have distrained rent. Then we also have deferred creditors. Now, let me consider that deferred creditors. Deferred creditors. So, the last item. So, I've talked about contingent and bankruptcy costs. I've told you the one not provided for. So, you will need to include it. Then, deferred creditors, which was part of M. Remember the M in the mnemonic? I said we have the distrained rent. Then we also have deferred creditors. Under that, though I've added the contingent and bankruptcy costs. Then, finally, we have preferential creditor. Preferential creditors. You already knew what will fall under this. You don't need to rank that. You don't need to rank the preferential creditor before, because they will be settled before other class of creditors would be settled. So we have preferential creditors. After that, we've done with the liability side. Then we move to the asset side. In the asset side, we have cash in hand. Any assets not used as collateral, just go through the question. Now you have been able to identify those assets used as security based on when you were categorizing your liabilities. You've identified those ones that were used as secured, fully secured. You've already knew those ones used as partly secured. Any other assets in the question that are not used as security, just write them out here. So you may have cash in hand, if any. The book value, the realizable value. Cash at bank, if any. The book value, the realizable value. Then debtors. The debtors may be categorized into good, the book value and the realizable value. The good one will be realized in full. Doubtful. Doubtful may not be realized in full. Then we have bad. Those ones that are bad, you can't get anything from them. Then inventories. Inventories not used as securities. Remember, I've told you assets not used as securities are what you need here. Then bills receivables. Any of these assets may be used as security in the question, but you have to look at the question. Which one are not used as security? Those ones not used as security are those ones you need here. Then life insurance policy. Life insurance policy. Then you may also have shares and stocks. Shares and stocks. Shares and stocks. Then you may have motor vehicles, if not used as security. So you have that, motor vehicles. Motor vehicles not used as security. You may have furniture and fittings, those not used as security. Furniture and fittings. You may have plants and machinery not used as security. Then, after, if you have any other assets not used as security, that the one not specified here, so you write them. You sum up all these assets, you have this as the total. Now you've gotten the total of all those assets. The next thing is to go back to the liability side here. Remember, you have fully secured creditors. We have surplus in hands of fully secured creditors. What you have as surplus here. That surplus will need to be considered and will be made available for distribution. Surplus in hands of fully secured creditors. Surplus in hands of fully secured creditors. Then, if there is surplus in hands of distrained rent, you will need to add it. Surplus, if there is surplus in hands of landlord, that will be made available for distribution. After all that have been considered, you have this as the total. Now, after that, if you have preferential creditors, remember preferential creditors was not made available for distribution at the left-hand side. We didn't rank it. We just put that. We only put it in the gross liability column. We didn't have preferential creditors here. It was not ranked. So, because they will be settled ahead of other classes of creditors, so you now consider preferential creditors. Preferential creditors. If you subtract it, you have the balance. This is the balance available for distribution. This balance that is available for distribution, you now total the debit side. How much is the total of what you have in the left-hand side here? You add under the expected to run, this column, sum up everything there. So suppose you have this as the total. You now compare this total with what you have here. You compare the two total. So the total here may be greater than the balance you have left at the credit side. So where the total is greater, where this is greater than this, the difference will be deficiency. Deficiency, that is balancing figure. Balancing figure. Come to the same level, we have the total. Then, and it is possible the credit side may be greater than the debit side. Where this credit side here is greater, then that is what you have here. If it is greater than the total of the left-hand side, then you have surplus as per statement of affair, which is balancing figure. That wrap up our deep dive into statement of affairs and deficiency accounts. Hopefully, you now feel more confident in navigating these key bankruptcy reports. In our next lesson, we are going to put this theory into practice by walking through a complete standard length worked example step by step. You won't want to miss that. So make sure you hit the subscribe button and turn on notifications. If you found today's breakdown helpful, please leave a like. It really helps the channel reach more students. And if you have a study group or a colleague who is struggling with insolvency and accounting, feel free to share the link with them on Facebook or WhatsApp. Thanks for watching, and I see you in the next video.